What does it really mean to own an apartment in a big vertical city like New York or Washington, D.C.? Is it as simple as buying a house on a plot of land, just, well, higher up? Or are you actually buying into something fundamentally different?
It's far from straightforward, isn't it? When you're looking at multi-unit buildings in these dense urban environments, the concept of ownership can take on very distinct legal and financial forms that go way beyond just having a roof over your head.
Exactly. And we've had a listener share a treasure trove of sources, articles, research, personal notes, even a snippet from a Reddit thread, really digging into two of the most prevalent and often confusing ways people own their apartment in these places. Condominiums and cooperatives.
Condos and co-ops. Yeah, they sound similar, but they're really quite different beasts.
Yeah. Right. So our mission in this deep dive is to cut through the complexity, unpack the core distinctions laid out in this material. We're talking everything from the bedrock legal structure to the surprising financial impacts and, yes, the fascinating power dynamics of living under different kinds of boards. We want you to walk away understanding what genuinely separates a co-op from a condo.
Okay, let's do it. Let's unpack this, starting with the most fundamental distinction the sources highlight. The absolute core difference lies in how the law classifies what you are actually purchasing. With a condo, you are acquiring real property.
Well, real property. Okay.
But with a co-op, you are acquiring personal property.
Okay, real property versus personal property. That sounds like a pretty foundational legal concept, but how does that translate into the everyday experience of someone buying or living in a condo?
Right. So for a condo, it means you own your individual unit outright. Like you own the space within its walls, floors, and ceiling.
The actual physical space.
Exactly. Plus, you own a percentage share of the building's common elements.
Common elements, like the lobby, hallway.
Yeah, lobby, hallways, gym, roof, maybe outdoor space, the plumbing and electrical systems that are outside your actual unit walls, things everyone uses.
Gotcha.
And crucially, you receive a legal document called a deed, just like when you buy a standalone house.
A deed. Okay, familiar territory there.
And this deed is recorded publicly. It goes into the county records where the building is located, establishing your clear ownership of that specific piece of real estate.
So a condo is literally like owning a stack of property in the sky, confirmed by a public deed. That makes intuitive sense, kind of following the model of owning a house.
It does, yeah.
So how does the personal property aspect completely change the game for a co-op?
Well, it flips the script entirely. When you buy into a co-op, you are not buying the physical apartment unit itself, not the walls, not the floors.
Really? So what are you buying?
What you are actually purchasing is shares of stock in a corporation, and that corporation owns the entire building, the land it sits on, the structure itself, all the individual apartment units, everything.
Shares in a corporation. Okay, so how do I get to live in my apartment then?
Your right to occupy a specific apartment unit comes not from a deed, but from a different document called a proprietary lease. Think of it like a long-term lease granted to you by the corporation because you're a shareholder, giving you the exclusive right to live in and use a particular unit.
So instead of a publicly recorded deed, I get a stock certificate for my shares.
Correct.
And a proprietary lease for my apartment.
Precisely. And this is a critical distinction the sources emphasize. Neither the stock certificate nor the proprietary lease is typically recorded publicly in the way a deed is.
Ah, okay. So the building's overall ownership by the corporation is recorded, but my individual stake isn't in the same public property records.
That's generally right. The corporation's deed to the whole property is recorded, but your share ownership and lease rights are internal corporate matters, in a sense. And even the loan you might take out to finance a co-op purchase reflects this fundamental difference. It's not technically a mortgage secured by real property.
So what is it called?
It's usually called a share loan or sometimes a security agreement, and it's secured by your shares in the corporation and your rights under the proprietary lease.
Secured by the shares and the lease, not the apartment itself.
Exactly. And the public notice of this loan isn't a recorded mortgage document either. Instead, the lender files something called a UCC-1 financing statement.
A UCC-1? What's that?
It's a standard legal form under the Uniform Commercial Code, filed usually with the state, not the local county property recorder. It serves as public notice that the lender has a security interest, a lien essentially, on your personal property, specifically your co-op shares.
Fascinating. So legally, one is tangible real estate you physically own and publicly record, kind of like a house.
Right.
While the other is more like an investment in a company that happens to own the real estate, granting you a specific right to live there via a lease.
You've got it.
And the loan is secured against your stake in that company, not the physical unit.
That's the core legal difference.
Wow. Okay, it seems like that fundamental legal difference must cascade down into other practical areas, especially finances, like closing costs, maybe.
It absolutely does. And one of the most significant impacts the sources point out is on your upfront closing costs, specifically something called the mortgage tax in certain jurisdictions, particularly in New York.
The mortgage tax.
Right.
Anyone who's bought real estate or tried to in parts of New York knows that can be a significant expense.
It can be a major hit to your closing costs, definitely. Because a condo is classified as real property, getting a mortgage loan on a condo unit means you are subject to this tax.
And the rates aren't trivial, right?
Not at all. The rates provided in the sources for New York locations really show this clearly. For example, in New York City, if your mortgage amount is between $10,000 and $500,000, the mortgage tax rate is 1.88% of the loan amount, minus a small $30 credit.
1.8%, okay.
But if your mortgage is $500,000 or more, that rate jumps up to 1.925%, again, minus $30. And then for other counties mentioned, like Long Island and Westchester, outside of Yonkers specifically, the rate is a bit lower, 0.80% minus $30 for mortgages over $10, and only 0.30% for those under $10.
So just doing some quick math, if you're getting, say, a $600,000 mortgage on a condo in Manhattan, you're looking at roughly 1.925% of that amount in tax, which is what, over $11,000? Minus $30. That is substantial.
It really adds up fast. It can be a huge chunk of your closing funds.
Okay, so that's the condo side. What about co-ops?
Well, here's one of the key financial advantages of the co-op structure, and it stems directly from that personal property distinction we talked about.
Yes. No mortgage tax.
Bingo. There is no mortgage tax on a co-op share loan. Since you are financing the purchase of shares, which is personal property, and not placing a mortgage loan directly on the real property unit itself, that entire line item, which can be tens of thousands of dollars on a large loan, is simply gone, absent from your closing costs.
Wow, that's a huge potential saving right off the bat for a co-op buyer. That's really significant. What other closing costs differ because of this real property versus personal property structure?
Good question. With a condo, because you are acquiring title to real property, you typically need to purchase title insurance.
Right, to protect against claims on the ownership history.
Exactly. It protects you, and importantly your lender, against potential defects in the property's title history. Plus, you pay fees to the local government, the county clerk, usually to publicly record the deed showing you own the unit and the mortgage document showing the lender's lien. Often a power of attorney document needs recording too, adding another fee.
Okay, so title insurance, deed recording fee, mortgage recording fee. What about for a co-op, since it's personal property?
Well, think it through. No title insurance is typically required for the individual buyer because you're not acquiring title to the real property unit in the same way.
Makes sense.
And there are no deeds or mortgages on the unit itself to record publicly, so those potentially hefty recording fees are eliminated as well.
So what do you pay for recording-wise?
Yeah.
Just that UCC1 filing.
Exactly. As we mentioned, the lender files that UCC1 statement to put the world on notice about their lien on your shares. But the filing fee for a UCC1 is usually minimal. The sources suggest around $100 or so.
$100 versus potentially thousands in recording fees and title insurance.
Correct. So when you compare closing costs side by side, particularly if financing is involved, a co-op purchase tends to have significantly lower upfront costs than a comparable condo purchase, especially in markets like New York with that mortgage tax.
That's a really clear financial distinction. Fewer legal documents tied directly to real property means fewer associated fees. Okay, does the structural difference also impact how quickly a transaction can actually close?
It definitely does, and the sources provide some interesting average timelines here. A cash condo deal, no mortgage involved, can close relatively quickly, maybe around 25 days, give or take.
Pretty fast.
Yeah. But if you're getting a mortgage on that condo, the process naturally takes longer. You've got the lender's underwriting, the appraisal, the title review. That pushes the average closing time out to around 60 days. 2 months, basically.
Okay, 25 days cash, 60 days with a mortgage for a condo. What about co-ops?
This is where the co-op structure often leads to a noticeably longer timeline. A cash co-op deal averages around 45 days.
Wait, 45 days for cash. That's almost double the cash condo timeline. Why?
That's a great question. And it leads us directly into arguably the most impactful difference in daily life and definitely in the purchase process. the building's governance structure, specifically the power of the board.
The board, okay.
This is where that corporate structure of a co-op profoundly influences the transaction timeline, even for cash buyers. It's not just about the financing or the property type, it's about getting approval from the people in charge.
Okay, let's talk about the boards then. We've got the condo board, often called the board of managers, right? And the co-op board, or the board of directors for the corporation. Are they just different names for basically similar roles?
Not at all. Not even close, really. Their roles, and maybe more importantly, their power, are vastly different.
How so? Let's start with the condo board. What's their power level?
A condo board's power is relatively limited, comparatively speaking. They are primarily responsible for managing the building's common elements. Think maintenance contracts, repairs for the lobby or roof, staffing like doormen or supers, setting the budget for these shared areas.
Okay, managing the shared stuff.
Right. They collect the common charges from unit owners to cover these expenses. They also have the power to enforce the condo's governing documents, usually called covenants, conditions, and restrictions, CC&Rs, and bylaws. And, importantly, they can place a lien or even foreclose on a unit if an owner fails to pay their common charges.
So they make sure the building runs and people pay their share. What about that right of first refusal you mentioned earlier? Is that a big power?
Yes, that's one of their specific powers related to sales. When a condo unit owner has a buyer lined up, the condo board legally has the option, the right to purchase the unit themselves, stepping into the buyer's shoes at the exact same price and terms agreed upon.
Okay, so they could block a sale by buying it themselves. Does that happen often?
You mentioned earlier the sources say it's rare, and that's right. The sources confirm it's very rarely exercised in practice. It exists legally, and the board typically has to issue a formal waiver of this right for the sale to proceed, but it's not usually a major hurdle for the buyer or seller.
Got it. So it's a power, but not one that really impacts most deals.
Generally, yes, and this is the key contrast with co-ops. Generally, a buyer of a condo unit does not need explicit approval from the condo board to actually purchase the unit. The sale primarily depends on the buyer getting their financing in order and the seller accepting their offer. The board mostly just needs to waive that right of first refusal.
Okay, so the condo board manages the shared parts, collects dues, enforces rules, but doesn't typically control who buys into the building. Now, the co-op board,
Yeah.
and the sources suggest they hold, well, immense power.
Immense is not an overstatement. It's a completely different level of control. Because remember, you're not buying real estate directly. You're buying shares in the cooperative corporation.
Right, becoming a shareholder.
Exactly.
Yeah.
So the co-op board, as the elected representatives of that corporation, has the responsibility and the legal power to approve who gets to become a shareholder. This means they review and must formally approve every single potential buyer.
Every single one. Wow.
Everyone. And often, if the co-op allows subleasing, they typically approve every potential renter as well.
And this approval process is famously rigorous. Is that fair to say?
It truly is. It's known for being incredibly thorough, sometimes intrusive. It involves the potential buyer submitting a highly detailed application package.
What kind of stuff is in that package?
Oh, extensive financial disclosures, tax returns going back years, bank statements, brokerage account statements, proof of income, letters of reference, both personal and financial, background checks, credit checks. It's a lot.
It's like applying for a top secret clearance almost.
It can feel that way. And yes, after submitting all that paperwork, it often culminates in one or more in-person interviews with members of the board.
An interview too. What are they looking for there?
Well, the Reddit thread shared by our listener offered a fascinating perspective from someone claiming to be a board member. They said that while the financial review is absolutely stringent and essential, you have to meet their financial criteria, period, if an applicant's financials are clearly solid, the interview sometimes functions more like they called it a vibe check.
A vibe check. Seriously?
That was the term used. It's an opportunity for the board to meet the person face to face, get a sense of their personality, see if they seem like someone who will, fit well into the community fabric and be respectful of the building's rules and neighbors.
So it's not just about having the money, but about fitting in socially, potentially.
According to that perspective, yes. Once the financial hurdle is cleared, the personal interview can be quite subjective, focusing on that community compatibility aspect.
That's incredible. And did the thread mention the order of operations for this whole process?
It did, helpfully outlining the typical sequence. Often, you might fill out an initial short questionnaire even before you formally sign a contract to buy. Then you sign the purchase contract. After that, you typically get your appraisal done for your share loan.
Okay.
While waiting for the appraisal and your loan commitment letter from the bank, you're usually scrambling to compile that massive board package we talked about.
Right. Gathering all those documents.
Then you submit the full package, usually including your loan commitment letter, to the co-op's managing agent or directly to the board. And only then, if your package meets their initial screening criteria, are you invited for that board interview.
That sequence makes sense. The board wants to see you're financially qualified on paper and have your loan lined up before they spend their time interviewing you.
Exactly. It weeds people out earlier in the process.
But the ultimate power here, the thing that really sets co-op boards apart, is their ability to just say no, right?
Yep.
Even if you have the money.
Absolutely. And this is perhaps the defining difference in board power between condos and co-ops. Co-op boards have an incredibly wide latitude to deny an applicant,
On what grounds?
provided the denial is not based on illegal discriminatory reasons related to protected classes like race, religion, gender, disability, familial status, and so on.
Standard anti-discrimination laws apply.
Yes, although the sources note that navigating this can be complex and legislation like the NYC Fair Transfer Housing Act is evolving, potentially limiting how boards can use certain background check information, for instance. But assuming it's not illegal discrimination.
Then what?
Then they can deny an applicant for almost any other reason or even for no stated reason at all. They don't usually have to tell you why you were rejected.
No reason needed. That seems arbitrary.
It can feel that way to applicants, but legally, their power stems from protecting the interests of the corporation and its existing shareholders. This level of discretionary power to reject a buyer is simply unheard of with a typical condo board.
So they can essentially curate their community based on criteria that go far beyond just financial ability or maybe even standard background checks. What else falls into the co-op board's wide umbrella of control?
Oh, quite a lot beyond just buyer approval. Co-op boards set and strictly enforce comprehensive house rules, and these can be incredibly detailed.
Like what kind of rules?
Everything from whether you're allowed to have pets at all, or specific restrictions on size, breed, or number of pets, detailed regulations on subleasing if it's permitted at all, which it often isn't, or only under very strict conditions.
What about renovations?
Big one. Requiring formal board permission, often including review of plans by the building's architect, for even relatively minor interior renovations that wouldn't touch common elements in a condo. Things like changing flooring, moving non-structural walls, sometimes even painting requires adherence to certain standards or notification.
Wow. So you don't have as much freedom inside your own unit.
Definitely not as much as in a typical condo. The rules can also specify allowed times and days for moving in or out, deliveries, construction work, rules regarding noise levels, smoking policies, proper disposal of trash and recycling, use of common areas like laundry rooms or gyms. It's extensive.
So they really manage the day-to-day life within the building quite closely.
They do. And beyond the rules, they manage the co-op corporation's overall financial health. This includes managing any underlying mortgage the corporation holds on the building itself. We'll probably want to talk more about that.
Yes, definitely.
They manage the building's capital reserves, the savings account for future large-scale projects like roof replacement or elevator modernization. And they determine the annual budget, which directly sets your monthly maintenance fees.
Okay, so they control the money, the rules, and who gets in. What happens if someone breaks the rules or doesn't pay?
Well, tying back to that unique proprietary lease structure, they have significant enforcement power. They can impose fines for rule violations, and for serious breaches like persistently failing to pay maintenance fees or repeatedly violating significant house rules, they have the power to take legal action.
Legal action like?
Including initiating eviction proceedings against shareholders.
Wait, they can evict someone who owns shares in the building. That feels really counterintuitive to the idea of ownership.
It does, but it stems directly from that dual status you have in a co-op. You're a shareholder, yes, but you're also technically a tenant under the terms of that proprietary lease.
The lease again.
Right. If you breach the material terms of that lease and failure to pay rent, which is what maintenance essentially is, or consistently breaking major rules are usually considered material breaches, the corporation has the legal right to terminate your lease.
And if the lease is terminated?
Then your right to occupy the apartment ends. Subsequently, the corporation can force the sale of your shares, often at an auction, to recoup the money owed and remove you from the property. It's a different legal pathway than a bank foreclosing on real property like a condo, but the ultimate outcome can be the same: losing your home.
That's a powerful mechanism.
Okay.
That brings us directly to the practical implications of all these differences for future flexibility, specifically when you want to sell your unit or maybe rent it out.
Yes, this is another area where condos and co-ops diverge significantly. With condos, selling is generally much more straightforward and typically faster.
Why faster?
Precisely because that whole board approval process for the buyer is usually not a factor. The sale can move forward once the buyer has their financing and is ready to close, and the board has simply issued that waiver for its right of first refusal.
Less uncertainty, less waiting for board meetings.
Exactly. And subleasing, renting out your unit, is also usually permitted in condos. This offers a lot more flexibility if your life circumstances change, like you need to relocate for a job temporarily but want to keep the unit as an investment.
Are there any restrictions on renting out condos?
Sometimes. While wholesale prohibitions are rare, some condo associations might impose certain limits. A common one mentioned in the sources is restricting the percentage of units in the building that can be rented out at any one time, maybe to maintain a certain level of owner occupancy for financing reasons or community feel. But even with such limits, it's generally much easier to rent out a condo than a co-op unit.
Okay, so condos offer more ease in selling and more flexibility in renting. Now, co-ops, given the board's power we just discussed, I'm guessing flexibility is much more limited.
Significantly more limited, yes. Selling a co-op can be a lengthier and much more uncertain process precisely because of that mandatory board approval requirement for your buyer.
The board can just say no to your buyer.
They can simply reject a buyer, even one who seems perfectly qualified financially, often for reasons they don't need to disclose, and as long as it's not legally discriminatory. A source even mentioned anecdotal experiences where sellers felt boards might drag their feet or reject an initial offer hoping a higher one comes along, which creates real uncertainty and stress for the seller trying to move on.
That sounds difficult. What about subletting a co-op?
Subleasing is usually much, much stricter in co-ops, or even prohibited entirely in many buildings.
Prohibited. Like never allowed.
Yes, some co-ops simply do not permit shareholders to sublet their apartments under any circumstances, perhaps except for very specific hardship cases, maybe. If subletting is allowed, it almost always requires specific formal board approval for each prospective renter you find. They often have to go through a mini application process themselves.
So the board vets the renters too.
Often, yes. And even if allowed and approved, there are frequently significant limitations imposed by the co-op's rules. For instance, strict time limits on how long or how frequently you can sublet are very common things, like you can only sublet for a maximum of 1 or 2 years total during your ownership, or maybe only 2 out of every 5 years. They really want to encourage owner occupancy.
Wow. So the bottom line on flexibility seems to be a condo generally offers much more freedom to move, sell quickly, or rent out your unit as your life circumstances change.
That's fair to say.
While a co-op requires navigating a much more powerful and potentially restrictive gatekeepers, the board, both when you initially buy in and critically when you want to sell or lease it out later.
That's the fundamental trade-off in flexibility, absolutely. The trade-off for that potentially more vetted community feel and those potentially lower upfront costs in a co-op is a significant reduction in your personal autonomy regarding your living space and future transactions compared to owning a condo.
We've touched on the proprietary lease quite a few times now as the core document granting the right to occupy a co-op unit. Can we maybe dive just a bit deeper into what that lease actually contains and how it functions in day-to-day practice?
Absolutely. It's really central to the co-op experience. Think of the proprietary lease as the specific detailed contract that defines the relationship between you, the individual shareholder, and the cooperative corporation, specifically regarding your particular apartment unit.
How is it different from the co-op's bylaws? Don't they have rules too?
Good question. They both contain rules, but they operate at different levels. The co-op's bylaws govern the overall operation and management of the corporation itself. Things like how the board of directors is elected, the procedures for shareholder meetings, the general scope of the board's powers, voting rights, and maybe some overarching rules for the building as a whole. The bylaws take a broader corporate governance view.
Okay, bylaws are for the corporation structure.
Right. The proprietary lease, on the other hand, is the specific agreement tied to your shares and your right to occupy your specific apartment. It details your individual rights and obligations as an occupant of that unit. It's more focused on the landlord-tenant aspect of the relationship, even though you're also an owner.
So what are some of the key things the proprietary lease spells out for the individual shareholder tenant?
Well, the sources indicate it covers really crucial points. First and foremost, your obligation to make your monthly financial payments your share of the building's operating expenses, which we call maintenance fees.
Right, paying the rent.
Essentially, yes. It also outlines the services and repairs that the corporation is obligated to provide, maintaining the common areas, the building structure, providing heat and hot water, things like that, sometimes defining where their responsibility ends and yours begins, often at your apartment's perimeter walls.
Okay, defines responsibilities.
Exactly. It stipulates your obligation to comply with all applicable laws, local, state, federal, as well as complying with the co-op's own house rules and regulations, which are often incorporated by reference into the lease.
So the house rules are backed up by the lease.
Typically, yes. The lease often includes provisions about the co-op's right to access your apartment for necessary inspections or repairs, usually with reasonable notice unless it's an emergency. And critically, it details your responsibility for the basic maintenance and repairs within your own unit.
So it really clarifies who fixes what the co-op is responsible for maintaining versus what the shareholder is responsible for inside their apartment.
Precisely. The lease is supposed to draw that line clearly. For example, a common scenario given in the sources relates to repairs, like, say, a leaking window. The proprietary lease will typically state that the co-op corporation is responsible for maintaining the exterior structure of the building, and that usually includes the windows themselves.
Okay, so if the window frame is faulty and causing a leak.
The co-op is generally responsible for fixing the window frame itself. However, and this is key, if that leak causes damage to your personal property inside your apartment, maybe it ruins your paint, your wallpaper, your windowsill, or your furniture below the window.
Yeah.
The lease usually makes it clear that you, the shareholder, are responsible for repairing or replacing your own damaged personal belongings or interior finishes. The corporation fixes the source of the leak, the window, but not the resulting internal damage to your stuff.
That's a really helpful practical example of how the lease defines those boundaries of responsibility. Are there other common ways the lease might be referenced or used in daily co-op life?
Sure. Another example provided is dealing with a neighbor issue, perhaps excessive noise. Your proprietary lease likely contains clauses related to your right to the quiet enjoyment of your unit.
Quiet enjoyment.
If a neighbor is consistently disruptive, violating noise rules, you would typically bring this issue to the board or management. And your complaint is ultimately supported by the terms of your proprietary lease, which guarantees that right, and the fact that the neighbor is also bound by the same lease terms, or the house rules referenced in it, not to disturb others. It provides the contractual basis for enforcing many of the rules and obligations of living there.
It's clear the proprietary lease is absolutely central. You really need to understand that document if you're considering a co-op.
Absolutely critical reading.
And you mentioned earlier that financing a co-op is different too. We talked about the share loans for the individual buyer.
Right, the loan to buy the shares.
But you also mentioned something called an underlying mortgage that applies to the corporation itself. Can you explain that?
Yes, this distinction is really key when talking about co-op finance, and it affects every shareholder. We've covered share loans. Those are loans made to the individual buyer, secured by their personal property, their shares, and their proprietary lease.
Got it. Secured by the shares, not the actual apartment.
Exactly. And the sources make a point to highlight specialized lenders in this niche area, giving the example of the National Cooperative Bank, NCB. Apparently, they've been focusing specifically on financing housing cooperatives since the early 1980s, so they really understand the unique aspects. They've originated billions in co-op loans.
So they know how to underwrite these different kinds of loans.
Precisely. Because underwriting a co-op share loan is different than a traditional mortgage. Lenders like NCB offer various options for individual borrowers. Some follow standard Fannie Mae guidelines, FNMA loans, which have typical requirements for things like credit score. The source mentioned a minimum FICO of 620, but needing 740 plus for the best rates. Loan to value or LTV ratio, up to 95% possible, usually requiring mortgage insurance if it's over 80% LTV. And debt to income or DTI ratios, often capped around 45%.
Standard loan stuff.
Pretty standard, yeah, with various terms like 10 to 30-year fixed rates or adjustable rate mortgages, ARMs. The source even gave some example rates from whenever it was written, like 4.25% for a 30-year fixed, 3.625% for a 15-year fixed, but obviously we need to stress those are just examples from the source's date, and rates change constantly.
Right, just informational. What other types of share loans?
NCB also offers its own bank portfolio loans. These might have slightly different criteria, maybe requiring a higher minimum credit score like 680, perhaps a lower maximum LTV like 80%, maybe requiring you to show you have reserves like 6 months of payment saved up. But they might allow for larger loan amounts than the standard conforming limits, maybe up to $1.5 million according to the source. They also offer home equity lines of credit, or ADLOCs, secured by your co-op shares.
You can get an ADOC on co-op shares.
Apparently so, yes. For things like debt consolidation, unit improvements, tuition, emergencies, typically up to a combined LTV of 80%, including the first share loan. And the process for an individual applying for any of these share loans usually takes about 30 to 45 days, according to the material.
Okay, so that covers the individual side, how you get the money to buy the shares.
Yeah.
Now, what about that cooperative underlying mortgage? That sounds like something much bigger, affecting the whole building.
It is much bigger. This is a large commercial loan taken out by the cooperative corporation itself, not by an individual shareholder. And this loan is secured by the actual real property, the land, and the entire building structure, and potentially other assets owned by the co-op corporation.
Okay, so the corporation borrows money against the building. Why would a co-op corporation need to take out a massive loan like that?
There are a few primary reasons, as noted in the sources. Sometimes the corporation might have taken out the original underlying mortgage way back when the co-op was first formed, perhaps to purchase the building from a previous owner or developer.
Okay, initial financing.
Or they might need to refinance an existing underlying mortgage, maybe because the interest rate is high and they can get a better deal now, or because the original loan term is coming to an end and they have a balloon payment due.
Makes sense. Refinancing debt.
And very commonly, they take out these large underlying mortgage loans to fund significant capital improvement projects that benefit the entire building and all the shareholders.
Like what kind of projects?
Think the big, expensive stuff. Replacing the entire roof, upgrading old elevators, major facade repairs or pointing work, replacing the boiler or HVAC systems, maybe renovating common areas like the lobby. Things that individual shareholders couldn't possibly fund on their own through regular maintenance fees, so the corporation borrows the money needed.
Okay, so the corporation takes on debt for these big upgrades.
Yeah.
How do lenders decide whether to give a co-op corporation such a large loan? What do they look at?
Well, just like a bank underrates an individual applying for a mortgage or share loan, lenders like NCB have very specific criteria for underwriting these large, complex commercial loans to the co-op corporation. They need to assess the overall financial health, stability, and management quality of the entire co-op as if it were a business entity, because essentially it is.
What kind of things do they scrutinize?
They require and review a lot of documentation. The sources mention things like needing several years of audited financial statements for the co-op, the current operating budget, detailed rent rolls showing who lives there and what maintenance they pay, information on maintenance fee collection rates and delinquencies, and details about the physical condition of the building itself.
So really digging into the co-op's books and operations.
Absolutely. And critically, they look at several key financial metrics to gauge the co-op's ability to repay this large loan and manage its finances prudently going forward.
Like what kind of metrics?
A really important one mentioned is the debt service coverage ratio, or DSCR. Lenders typically require this to be at least 1.00x, sometimes higher. That means the co-op's annual operating income, which comes primarily from collecting maintenance fees from shareholders, must be sufficient to cover all of its annual operating expenses plus the annual payments, principal and interest, on this underlying mortgage debt. A ratio below 1.0 means they aren't bringing in enough money to cover costs and debt.
Okay, income has to cover expenses plus the loan payment. Makes sense. What else?
They look very closely at shareholder delinquency rates. What percentage of shareholders are behind on paying their monthly maintenance fees? Lenders have specific thresholds here. For example, the source mentions NCB might require that no more than 5% of the total budgeted maintenance income is over 30 days past due, or perhaps that no more than 10% of the units are delinquent by over 30 days. High delinquency is a big red flag.
Because if people aren't paying, the co-op can't pay its bills, including this big loan.
Exactly. They also want to ensure the co-op has adequate cash reserves set aside for emergencies or future needs, often requiring reserves equal to a minimum of, say, 10% of the co-op's annual budgeted income or gross potential income. They might also look at owner occupancy levels. Fannie Mae, for instance, might require 80% owner occupancy for certain loan types, while NCB might be okay with 50% plus. They also look at things like the concentration of sponsor or investor-owned units and the percentage of income derived from commercial spaces within the building, usually setting maximum limits for these.
So it sounds like even though this is a loan made to the corporation, the financial health and behavior of the individual shareholders directly impact the co-op's ability to get this financing right.
Absolutely. It's completely intertwined. The monthly maintenance fees collected from all the individual shareholders are precisely what fund the co-op's ability to pay the operating expenses and make the payments on this underlying mortgage.
So, a well-managed co-op with responsible shareholders who pay on time, healthy reserves, and low delinquency is more likely to qualify for better terms on an underlying mortgage.
Correct. Which benefits everyone.
And maybe less likely to hit shareholders with unexpected large special assessments down the road because they can finance needed repairs through these loans.
That's often the goal, yes. Conversely, a co-op that's struggling financially with high delinquencies or depleted reserves poses more risk not only to its shareholders through potential large assessments or service cuts, but also to lenders considering giving them an underlying mortgage.
So lenders scrutinize all these factors because they're essentially lending against the collective financial strength and stability of the corporation, which relies on its shareholders' ability and willingness to pay their maintenance fees.
You've nailed it. The underwriting process for these underlying mortgages is detailed, involving analysis of all those documents plus third-party reports like property appraisals and building condition assessments. The sources mention it can take a couple of weeks just for the underwriting once all the documentation is in, and there's often a significant application fee, around $12K mentioned, just to cover the cost of those third-party reports.
$12,000 just to apply. Wow.
For the corporation, yes, to cover due diligence. And even after the loan closes, the co-op usually has ongoing requirements to report its financials to the lender regularly and maintain certain standards, like keeping that DSCR above 1.0x, maintaining reserves, and keeping delinquencies low.
It really paints a picture of the co-op as a complex, shared business venture. Every shareholder's financial contribution, the board's management skill, and the corporation's overall financial health are all deeply interconnected and subject to pretty serious external financial scrutiny from these lenders.
That's precisely the model. It's a very, very different financial and operational structure than simply owning your individual box in a condo building where the association manages common areas but doesn't typically carry debt secured by the whole property in the same way.
And this particular type of ownership structure, the co-op, is it found everywhere, or is it more concentrated in specific areas?
Yeah, the sources definitely note that co-ops are much more prevalent in certain types of locations. They tend to be found primarily in large, older metropolitan centers, and often these co-op buildings themselves are older, frequently having been established or converted before the mid-1970s when condo laws became more widespread.
So where specifically are we talking about?
New York City is the most obvious and prominent example, right? Co-ops make up a really significant portion of the apartment housing stock there, especially in Manhattan and parts of Brooklyn and Queens. But you also find significant concentrations in other major cities mentioned like Philadelphia, Chicago, Seattle, and as noted in the context of our sources, Washington D.C. as well.
But less common elsewhere.
Generally, yes. They are much less common in newer developments or in more suburban or Sunbelt cities where individual home ownership or the fee simple condo ownership model became dominant much earlier or is just more prevalent.
Okay, so after exploring all these really fundamental differences, starting with how it's legally owned, real versus personal property.
Right, the core distinction.
Then the contrasting closing costs, that big mortgage tax difference.
Huge financial impact up front.
The varying monthly expenses and how taxes and utilities are handled, plus deductibility.
Yeah, comparing total monthly outlay is key there.
Then the immense power difference between the co-op board versus the more limited condo board.
Maybe the biggest practical difference day to day.
Which leads to big differences in flexibility, or lack thereof, when it comes to selling or renting.
Definitely impacts your exit strategy and options.
And finally, understand these distinct financing models, both the share loans for individuals and those big underlying mortgages for the co-op corporation itself.
Two separate but connected layers of debt.
After all that, how does someone possibly decide which path, condo or co-op, is the right one for them? It seems complicated.
It really does come down to aligning your personal priorities, your lifestyle, your financial situation, and, frankly, your tolerance for rules and communal decision-making with the specific structure of each type. Neither is inherently better. They're just fundamentally different.
So what are the main appeals of a co-op, given the restrictions?
Well, co-ops can be very appealing for several reasons. As we discussed, they often come with significantly lower upfront closing costs, primarily due to avoiding that mortgage tax and title insurance fees in places like New York.
Save money at closing.
Yes. And sometimes, though not always, the purchase prices for co-op units might be somewhat lower than for comparable condo units in the same neighborhood, partly reflecting those restrictions and the smaller buyer pool.
Potentially a lower sticker price, too.
Potentially. Plus, for some people, that very stringent board approval process, while a hurdle to get through, is actually seen as a positive. It can create a potentially tighter-knit, more stable community where neighbors have all been financially vetted and perhaps assessed for compatibility. You might feel you have more control over who your neighbors are.
Okay, so lower costs, maybe a lower price, and a sense of a vetted community. But that community vetting comes at the price of individual freedom, doesn't it?
Absolutely. That's the major trade-off. The power of the co-op board is a significant factor you have to be comfortable with. They have that broad discretion in who they approve to buy in. They set and enforce extensive house rules that can be very restrictive regarding things you might take for granted elsewhere, like pets, or doing renovations inside your own apartment, and especially subleasing.
And selling can be harder.
And when it's time to sell, you face that uncertainty and potential delays of getting your buyer approved by the board, which can impact your ability to move on your own timeline.
Okay, so that's the co-op package. Potential savings and community vetting,
Yeah.
but with significant board power and restrictions. What about the condo side? What's the appeal there?
On the flip side, condos offer more of that traditional sense of individual ownership freedom that many people value highly.
You own it outright.
Exactly. You own your unit fee simple, just like a house. The purchase and sale process is generally simpler and faster, mainly because that subjective board approval process for buyers is typically not required.
Easier to buy and sell.
Generally, yes, and subleasing is usually permitted, maybe with some building-wide caps, but it gives you much more flexibility if your life plans change and you need to rent it out. You also usually have more freedom to renovate the interior of your own unit as you see fit, provided you're not messing with structural elements or common building systems.
So more autonomy, more flexibility. But that freedom usually comes with a higher price tag up front, right?
Yes, that's often the case, primarily due to those higher closing costs like the mortgage tax and mandatory title insurance in many markets. And it's worth reiterating the point about monthly costs.
Right. Common charges versus maintenance fees.
Yeah. While condo common charges might appear lower on paper than co-op maintenance fees for similar apartments, it is absolutely crucial, as that Redfin agent's perspective from DC highlighted in the source material, to compare the total monthly housing costs side by side for an accurate picture.
What goes into that total comparison?
For a condo, your total monthly outlay is the common charge, plus your separate property tax bill, which is often paid semi-annually or quarterly, but you need to calculate the monthly equivalent, plus usually your own separate utility bills for electricity and maybe gas inside your unit.
Okay, common charge plus property tax plus utilities.
Right. For a co-op, that single, often higher monthly maintenance fee frequently includes your unit's pro rata share of the entire building's property taxes, and sometimes it even includes certain utilities like heat and hot water, maybe even gas.
So the maintenance fee covers more items, potentially.
It often does. So that higher single co-op payment might actually be similar to, or even less than, the combined total of common charges plus separate property taxes plus utilities for a comparable condo. You absolutely have to look at the full monthly cost picture, apples to apples, not just the headline common charge or maintenance fee number. And also consider the tax deductibility differences we touched on. Condo property taxes are usually fully deductible, while only a portion of co-op maintenance, representing taxes and underlying mortgage interest, typically is.
That's a really important point about comparing the total monthly nut. So the decision isn't just about the square footage, the view, or the amenities, is it? It's really about the entire legal and financial ecosystem you're choosing to enter into.
Absolutely. It's not just buying an apartment. It's choosing a whole framework of ownership, governance, and financial responsibility.
You are really opting into a specific legal and social contract when you buy either one.
Precisely said. And it just underscores how absolutely vital it is for any potential buyer, whether you're looking at a condo or especially if you're considering a co-op, to thoroughly read and truly understand all the governing documents for that specific building before you sign on the dotted line.
What documents are key?
For a condo, you need to read the declaration or master deed, the bylaws, the rules and regulations, recent financial statements, and meeting minutes. For a co-op, it's even more critical to scrutinize the offering plan, if available, especially for conversions, the corporation's bylaws, the house rules, the recognition agreement lenders use, recent audited financials, board meeting minutes, and most importantly, that proprietary lease specific to your unit.
Because the rules and the financial health can vary dramatically from one building to the next.
Hugely, even between two buildings right next door to each other that look identical from the outside. One might be financially sound with reasonable rules, while the other could be facing major assessments or have incredibly restrictive policies. The specific documents tell the real story. Due diligence is paramount.
Excellent point. The devil is truly in the details, maybe more so than with a single-family house purchase when it comes to these complex, shared ownership structures.
Indeed it is. And, it kind of leaves us with a compelling, almost philosophical question to consider as we wrap up this deep dive, thinking about the unique nature of co-ops.
Oh, what's that?
If owning a co-op means you are simultaneously a shareholder in the corporation that owns the actual real estate, and you are also technically a tenant under a proprietary lease granted by that same corporation, can the traditional clear line we draw between being an owner and being a renter ever truly disappear in that structure? Or is it always inherently fundamentally blurred?
That's a fascinating legal and conceptual puzzle. Are you an owner, a tenant, or something uniquely in between? Lots to think about there. Thank you so much for guiding us through this really intricate comparison of co-ops and condos today.
My pleasure. It's a complex topic, but hopefully we've shed some light on the key differences for listeners.